So have highlighters as well. Have them ready. Um, I want to say a few things. I know that some of you will have family members or friends or uncles, aunts, loved ones that are in this business. They're financial advisors, or they're some, like maybe a financial officer. They work with a bank, stuff like that. I'm not claiming to know more than your folks, right? They might actually know more than me. So at any point, if I say something that they tell you it's like actually this is not 100% right, you can come and talk to me. I'm not claiming to know it all. I have a bit of an overall general understanding of the financial world, but I don't know it all. Okay, so that's my a disclaimer here. Um, you will probably, some of these concepts will be like over your heads right now because you're young. You haven't invested a whole lot. You might only have a checking and a savings account, right? That's understandable. But as you get older, some of these things will come back to you. It's like, oh yeah, I remember Mr. Dirksen talking about it, right? Now's the time. And then at least you know. If you can sit in someone's office and know what they're talking about to a certain degree, the words that are being said are not completely new to you, you have more power. You have more decision-making power because you can be like, whoa, whoa, wait a minute. I remember RSPs, like we talked about that. Can you explain a little bit more, right? Like you can actually like have a voice in that meeting, right? That's kind of what I want you to understand, okay? So we're going to talk about investments, and then we're going to talk about loans, credit cards, mortgages, like borrowing money, right? Chapter 2 is borrowing money. Chapter 1 is investing, and it's investing for the future, right? Did you know that uh, the biggest problem for people these days not being able to retire is the fact that they borrowed too much and they did not save up enough? Those are the two things. So you're getting to 60, 65, it's time to retire, because everybody tells you 65 you retire, right? Not really. Not if you don't have the financial means to do that, you cannot retire. Like you cannot. I'm going to tell you that. Have you heard of CPP, Canadian Pension Plan? You might have heard of it. CPP is not going to get you by. Absolutely not. CPP is only 25% of income. It will pay you out about 25% of what you made towards the end of your career. That's it. You cannot live off of that. You're going to have your own little stash somewhere to compensate for that. And you might say, well, Mr. Dirksen, I will have my house paid off, my car will be paid off. It's still not enough. You still need to eat. You might want to travel. You still, right? There's bills that come, like hydro bill. Oh my goodness, my hydro bill is $300 every month for heating and running my appliances. $300 every month. Water, right? $100 every month. Property taxes. You know that we pay property taxes on anything you own, condo, house, anything. You pay property taxes. I pay about $380 a month, just property taxes. Even if your house is paid off, the government is still going to charge you that every month. Okay, so this isn't going to cut it. You're going to have your stash. And I will tell you this: time is your greatest asset as a young person. Time. If you can put money away now when you're young, and let's say you get into your 30s and you're like, I have all these other things going on. Maybe you're starting a family, maybe you have more responsibilities. Then you can say, well, I can't put more money in my stash. I have to pause a little bit. But if you have money in there, the money just sitting in your account will grow, will still keep growing, will still earn interest. And so you can just let it sit there, and it's a small snowball, but it will get bigger and bigger on its own. Versus the opposite is to wait until you're 30 and 40. I will have more money back, like when I'm 30, 40, maybe 50. And then you start putting money into that account, you no longer have time on your side because you're really close to retirement. Actually, 10, 15 years is not that much if you think about it on the big picture. So you have too many loans, right? Too many of them, and not enough investing. If you didn't invest enough and you have too many loans, that's a problem. The third problem that we have is longevity. A lot of people live longer these days. So it's actually a problem. Like, this is what I mean by that. You need to have more stashed away to live longer, because you're gonna need to have that stash, because you can only withdraw so much. So if you're running out of money set aside, that's a problem. And it's not uncommon that people live up to their 90s. It's not uncommon. So longevity, living longer, and you're going to have health issues towards the end, perhaps, possibly not, but you're going to have your bills for prescription drugs and all that is going to go up too, right? So these are the things to keep in mind as we're going through these units, through these 2 chapters. All right. I want to right away, because it's going to come back over and over. This is the saying that I put in. It's going to show up in the next page as well. But compound interest is the 8th wonder of the world. He who understands it, or she, right, earns it. He or she who doesn't will pay it. That's what Albert Einstein said, right? If you don't understand how interest works, and it's specifically compound, then you will pay it, and that's not a good thing. You want to earn it, you don't want to pay it, right? So here we go. There it is one more time. And to be honest, this is the first time I look at the whole thing printed. So from time to time, I might pause here, and I won't ask you to write everything down. But I want to tell you this, the page numbers got kind of cut off. That is really too bad. At the top there's a page number. That's supposed to be page 3. And I noticed this as I was sending it off, that the page numbers didn't make it. So half of the document has them and half will not have it. But so you're just going to have to follow along even more closely. A small long-term investment can be worth more than a large short-term investment because time is on your side. Here. Time is on your side. Okay? The principal will keep on accruing compound interest. Because this is why you earn interest on interest. You earn interest on interest. The longer it sits, the more often the interest is compounded. You earn money via interest instead of having to invest from your own pocket. Okay, so that's something very important to understand. Interest is going to show up later on. I'm going to define it. So right now, if you're wondering, what is interest? Interest is the money you earn on your investment or your savings. Like it's usually a percentage, right? It's quite common, a percentage. So if you look at a bank, right, 2-3% for savings, that's what you earn, right? 4 questions to get us started. Interest is a word that is used a lot in this unit. What do you already know about interest in the context of financial services or money? So just something to think about, right? What do you already know? You might know something already about interest. Show of hands. Show of hands. How many of you have a savings account right now? Savings account. It's a bit higher. I can't see it. Yeah, savings account. Okay. A lot of you have. I can tell you this, the savings account from a bank are very low, 1-2%. That's it. They're higher now because the interest rates for loans are going up. The banks always play catch up. So to understand what a bank does is it takes the savings from people, right? It has a stash of savings, right? People give the bank the money, they have it. They take that money and give it out as loans, right? They give it to people. Hey, you want a mortgage? Hey, you want a car? You go ahead. So they might charge 5% for a loan interest rate, right? They charge you interest, and they'll say, hey, we'll give you 2% for you putting your money in the savings. We'll pay you 2%, but we will charge 5% to everybody else that's borrowing from us. So that difference, right? In this case, there's a 3% difference. That's the profit the bank makes. The bank is basically the middle person, right? It's like, hey, give me money, and then they take it and they give it out to somebody else. That's basically how they make their money. And it's a good business plan. I'm not saying banks are bad. I'm just saying that's what they do. So if the government right now, the interest rates are actually super high, like 7-8% for a car loan, 5% for a mortgage. So if this goes up, the bank usually does the same. They're like, hey, we're going to give you more for your savings. They want people to put in savings because they can use that money to give out to people to buy their houses and cars and stuff like that. So that's what the bank does. So there's an interest you get paid, but there's also interest you get charged. It's basically, it's the financial charge for either borrowing or saving, right? So saving, they would be paying it to you. Loans, they'd be charging it to you, okay? So what financial services do you have right now? Other than savings account, what other financial services can you have? Other than a checking and a saving account, what else can you have in the bank? What's that? Credit or a loan. It's called a line of credit. Have you ever heard of a line of credit? LOC. A line of credit. It's basically, I have a line of credit. I can go and take out money anytime I want and buy whatever I want with it. So it's kind of like a credit card, but it's through the bank. Yeah, a line of credit. So we can see that line of credit. Okay, line of credit. Anything else? Do your parents maybe have something going for you for post-secondary? Did they tell you if you have a stash there for you when you go to university? They might have something like this. It's called the RESP. Have you heard of that? Registered Education Savings Plan. I did that when both of my kids were born. I opened one right away from day one. So that's a good one. So when they turn 18, they can take money out. They can pay either for tuition, for books, even I think living expenses if you live on campus, right? So RESPs. Have you heard of RRSPs? Registered. So the first one is registered. It's with the government. Registered Retirement Savings Plan. Okay, I'm going to talk about it again later. That's why I'm not giving you the definition here. But these are some financial services you might have. You might have loans, right? You might have a checking account, savings account, and so forth. You might have a GIC. Have you heard of a GIC? Have you heard of a GIC? No. I can almost put money down that this week, if you focus on the bank, when you drive by a bank, you're gonna start seeing GICs on their sign. 2-year GIC, 3-year GIC. Yeah. That's a guaranteed investment certificate, and so that's also an investment. Okay, so I'm going to stop talking about that. What financial services do you think you will use in the next 5 years? Probably these ones, right? Loans, checking, savings, for sure. You might take out of the RESP that your parents or guardians set up for you. So that's something just to think about. What financial services do you think you will use in the next 25 years? Right? I will say this, probably a mortgage. Mortgage, loans, line of credits. Right? In the next 25 years, I'm very certain you will use that. I'm very certain you will use that. Even if you're renting, you might still buy something that you need a loan for. And credit cards. Careful with credit cards, guys. It sounds great, but their interest rates are usually 20% plus interest rate. Like it's crazy. Um, I would try to stay away from them. And I'm talking to myself here as well. I need to stay away from credit cards. Not just talking to you. So this is page 4. Lots of definitions here. Um, you need to be familiar with the vocabulary, so don't worry about having all of this on your study sheet. It's going to be too much. But investment is a method of saving with the intent of earning additional money for future use. Also the amount of money which is being used for this purpose, right? When investing, we consider the following. This is important. There is the principle which we often get the letter P, right? Which is the original amount. The original amount invested. And why are you doing that? You would never just put your money in there for no reason. I don't think you should say, oh, I'm just going to put it in there because I don't want to have it under my pillow, right? You are actually trying to gain interest, right? You want to gain interest. And interest, which gets the letter I, is the amount earned, right? Money earned or paid, right? It's earned or paid. It depends on what it is. Is it investment or is it loan? Okay. There's the interest rate. Okay. Rate at which investment will increase. Stated, watch this, stated as a percentage per year or annum. Don't be thrown off. That's just a yearly per year. It's the same thing. But on a legal contract, if you go sign something at a bank, they will use this word. Okay, quite often. So you gotta just be familiar with it. Convert to a decimal when entering into formulas. I don't know if I need to highlight that, but it's important to remember. Term or maturity, that's usually time, right? The contracted end date of a loan or investment. I will say this, can be stated in months or years. Okay, we'll add that to the term. So sometimes to say, hey, the term of this loan is 60 months, 5 years, right? The future value. Future value, A, total accumulated after maturity. In general, watch this. I want this highlighted. The future value, which is denoted by the letter A, is the principal plus any interest that you've earned. In short, is A equals P plus I. That's probably worth boxing in because I'm going to use that quite often. I'm going to use that formula quite often. Return on investment. We are going to get to math, but first I need to do these because they come up. They just throw them in there, and I need you to know what they mean. Return on investment, right? The amount of money gained through an investment, also worded as the increase in value of an investment, can also be called interest. Return is future value minus initial value. Okay, I will say this, can be negative if there's a loss. I actually I invest in moderate to high risk investments as well. I have like a little stash, and I lost money over COVID, right? Like it didn't do so well, but it will go back up, right? So you never, when you make long-term investment, you don't panic when it goes down because you know you're in there for the long haul, right? So usually it gains back and you will make up the money. And we'll talk about that later a bit more. This is important. This will be coming up quite often. So maybe I'll use a different highlighter for this one because it is important, right? Rate of return, ROR. I'm going to use that quite often, guys. The amount of money gained or lost expressed as a percentage, right? It's expressed as a percentage of the amount invested by the owner of the investment. Note, this is not necessarily dependent on the amount of time involved, okay? Not necessarily dependent on the time involved. It just simply tells you how much did you gain or lose in this investment from the beginning till now, okay? So this formula should definitely be on your study sheet, okay? No doubt about that, okay? This should make it onto your study sheet, guaranteed. So how do we calculate that? It's the future value minus the initial value, which we call the principal, divided by the initial value. Okay. Annualized rate of return. It's not part of the curriculum, so I think I'm just going to briefly run over it. It's not a big deal, but I will show you what that means. So I have return, rate of return. This is the ROR. And annualized rate of return, which I'm going to show you. So let's say you invest $1,000. After 3 years, you accrued interest, earned. This is the same thing as earned. Accruing something is earning, or it's building, right? You accrued interest, and it's now worth $1,200. So you start with 1,000. So this is your principal, okay? And this is your final amount. Okay. So to figure out the return, it's just taking the $1,200 minus the initial amount. So it's just $200 gain. And notice that it's positive, so there's a gain, right? The rate of return is a little different. It's stated as a percentage. So we do the same thing as before. And don't focus so much on this. Focus on the rate of return. So it's the final amount minus the initial amount divided by the initial amount, okay, which is $1,000. Okay, and all of that will be multiplied by 100. So in turn, 1,200 minus 1,000 is 200 divided by 1,000. We multiply that by 100. And what do we get there? 200 divided by 1,000, that's 0.2. We knew that, right? Times 100, that's 20%. Okay. And notice that it's positive, so that means that you from the beginning to the end, there's a 20% increase, right? 20% increase. Annualized rate of return is just taking the 20 and dividing it by the number of years that went by. That's all you do there. Okay, so then it's kind of saying, hey, how much would this have been per year? 6.67%. But this is what I really want you to focus on right now. That's what I expect you to do quite often. Before I move on, okay, future value minus initial value, right? When you subtract these two, the $200 is really what we earned, right? And so this is often referred to as interest. It is really the interest that you've earned, right? Interest earned or lost. So make sure you add that to understand that, right? When you subtract that, it's like, hey, I started with 1,000, I now have 1,200. you earn $200 in interest, right? That's really what's happening there. So sometimes we will know this right off the bat, so there's no need to subtract like this. Okay, okay, keep going. Yeah, a lot of I think I might. Yeah, I think if I skip this, it's gonna bite me later. As much as I would like to, because I know this stuff, but you don't necessarily. Okay, risk. This is on page 5, but there's no page number, so just keep going till you see this, right? The possibility that investment will have a negative return on the investment. So there's a net loss rather than a gain. So no surprises there. In general, high risk investment offers this is important, this concept. A higher risk investment offers a greater return, but there's also a higher probability of loss. You need to understand that, right? Why would you risk? Like, why would you risk? Because there's a potential for more return. That's why people risk, right? But there's also a higher probability of loss, right? So example is cryptocurrency, right? People are like, yeah, that's the hype, right? So they know it's a great risk, but there's also potential for great gain to be had. So that's what the pull is, but there's also a probability of high loss. Low risk investments are usually safer, but offer a lower return. Example, a savings account with a bank, right? So low risk, low return, high risk, high returns, potential high returns, I must say, right? So keep that in mind. Portfolio, what in the world is that? It's a collection of investments. That is important. You need to know what a portfolio is. Portfolio is a collection of investments. Most people are advised to diversify. So right now you might think it's a little boring. Please try to listen and try to understand what we're doing. Diversify their investment portfolio. You are essentially making sure you don't put all your eggs in one basket. That's what diversification means. Like, don't put all your money in cryptocurrency. Don't put all your money just in low savings account, right? A low return. Diversify. Put some in each, right? So don't put all your eggs in one basket. Okay. Mutual funds. Um, as the name kind of suggests, you're putting a bunch of funds together. A managed investment that can be bought and sold as a single item, but is usually a portfolio itself. Here's a more formal definition. I will leave that to you, and I might come back to that a little later. Um, I left that page blank here for a reason. So a mutual fund is what banks do. So for example, let's say this is uh, financial service provider. So what they do is they take money from a bunch of people, right? So everybody so a bunch of people, they say, hey, I want to invest in this mutual fund, okay? The financial service provider, they manage that money for you. You don't go on the trading, you don't go and trade shares all the time. Like that's too much work for some of us. But they take that money, they pool it together, and then they will invest it in either a high, a mid, or a low risk investment. So they pool the money together. So mutually, they take all that money from different people and they invest it in either high, medium, or low risk investments. Okay. And so And you're like, well, how you decide this, Mr. Dirksen? They ask you what you're comfortable with. They asked me, like they actually asked me and my wife, like we were right next to each other. My wife does not like to risk, so she put all of her money in the low risk, right? I like to risk somewhat, so I put my money here. I didn't go high risk. I went moderate, medium to moderate risk. So then they're like, okay, so low risk investments will look something like this. They will invest in real estate, right? Real estate, construction, and so forth. Safe investments, right? Medium risk, they might buy some shares in the market, right? Some shares in the market. They might also do some real estate to balance off the risk in the shares in the trading world and so forth. And then high risk would be energy sector. And I'm just giving you broad examples here, but I don't know if you follow the market. Probably not. But the energy sector is always like this. Oil goes up, and then goes crashing down. Right? Like right now, it's actually went down quite a bit, and then it goes up, up, up. So the energy sector goes like this. So there are gains to be made, but it's a higher risk. Okay. So this is based on you. So that's what a mutual fund kind of does. Okay. And they don't put all your money in one basket either. I have a printout where I have like 10 or more different companies they invest in. They don't just put all your money in one place. So that's a good thing. I think there's a printout here at the end. You want to go to the very back. To the very back, it's a little blurry. So I think it's page 109. Go to page 109 at the top of the page. Actually, this one made it, so I'm happy about that. I think some of it got cut off. But I want you to look at. Oh, it did cut. They did cut it off a little bit. But this, if you look at page 109, this is one mutual fund investment. And watch what it says here, the top 10 holdings. That's like the top 10 companies that they invest in. And here they are, right? I don't know the names of a lot of them, but there's Bank of America, Wells Fargo, I know that's a bank too, JP Morgan, right? So Samsung Life Insurance. So they invest in all these things. And that's not all of them though, but these are the top 10. If you were to invest in this, in the Mackenzie Global Financial Fund, if you pick this one, this is kind of the overview of that investment. And they tell you this, like the returns over the years, right? 1 month ago, 3 months ago, from a year from now, right? 3 years, 5 years, 10 years ago. So sometimes there was even a loss, right? You can see when the bar goes below, it's a loss. So it kind of shows you that. Not only do they do that, watch this. If you go to page 110, this fund that we just looked at, it tells you where the money is going, right? Foreign equity, United States equity, cash and equivalents, Canadian equity. So this is mainly foreign or United States, right? This one. It's not really invested in Canada a whole lot. And then they actually tell you the countries that they deal with, right? So the United States gets 36% of the money. Australia, Japan, Korea, Ireland. So this investment, it's so diverse, it's actually a pretty good investment. Not only do they go with different companies, they go with different countries. So if some countries have a crisis and you might lose money there, you might have a good gain in the United States, right? So I just threw this in as well. That's why the booklet is so thick. But this is actually this is a mutual fund. You want to write that down at the top here. Mutual fund example. And I will go back to page 5 and just tell you, hey, if you want to see one, you go for it. So we can put here example on page 109. Okay, guaranteed investment certificate. A certificate issued by a financial institution. This is important. I'm going to highlight that. This will show up quite often. A guaranteed investment certificate. It's given by a financial institution where the investment is made. The rate of return is fixed. Watch this. Rate of return is fixed, and the term is fixed as well. Okay. GICs are usually offered in various terms. You can purchase 1 year, 2 year, and up to 5 year GICs. Watch this. The higher the rate, higher rate. Sorry, that was supposed to say the higher term. The higher the term, the greater the interest rate. So an example would be a 1 year GIC, I think right now is 2%. A 3 year GIC would probably be like 3.1%. A 5 year would maybe be 4.8%, right? So the higher the term, the greater the interest rate they tell you. You cannot access funds prior to maturity. That is the biggest downside of a GIC. Once you say, hey, 5 years, you sign, you leave it there for 5 years. You cannot change, you cannot move it. There is a penalty if you do so. It's possible, but you will lose money. So once you lock it in for 5 years, you leave it there. And why they do that is because now they can take that money and not have to worry about you taking it out in either 5, 3, or whatever years, right? Like you're locked in. Bond, a kind of investment that where you purchase, right? You purchase the debt from a company or government. Canadian government used to have a Canadian watch this. CBS is the Canadian Savings Bond. Okay. No longer offered. Even though the textbook and my worksheets might have, but they actually shut that down 2 years ago, a year ago. So I will have to update my worksheets for sure. But basically, the Canadian government says, hey, if you buy bonds from us, we will give you an interest rate. We will guarantee an interest rate. So you're basically giving them money so the government can pay off their debts, and then they pay you back in a year or two or longer, whatever you. So that's kind of like a way of they get a cheap loan in that sense because you're like, hey, that's not a bad interest rate. Like I'll put my money in there, so you help them out. Okay. You're like, aren't they taxing us? Isn't that good enough? It's like apparently not. TFSA. You know what a TFSA is? Tax-free savings account. As soon as you turn 18, you can open a tax-free savings account and you can put in $5,000 every year, and everything you earn on it is tax-free. Okay, so you don't have to pay taxes on what you earn. Okay, tax-free savings account is important. That one will show up too. Savings investment by the government of Canada in order to encourage savings for retirement. investment earnings held are not TFSA is not taxed as income. And withdrawals are also not taxed. Okay, so that's the nice thing about a TFSA. Okay, I know, guys, I wish I could skip this, but I'm trying my best to make it quick, but I can only do so much. Right? Market-based investments. So that's the next page there, page 6. Let's put page numbers as we do this so that at least I can, if I need to refer back to something, it's there, right? Market-based investments, assets whose price is determined on a marketplace such as a stock market or real estate. The return is not fixed or consistent. Okay, so return is not fixed or consistent, and it's based on stock market or real estate. It can be volatile with strong gains or sharp decreases. Okay, notice that word volatile. Volatile means it goes up and down. Strong gains, sharp decreases possible. The appeal of these types of investments is the potential for higher return. Right? There's a potential for higher return compared to low risk investments that offer fixed rates. Dividends, payments that are made by businesses to shareholders of that business. Okay, I don't think you need to worry about this too much. Dividends are paid annually, depends on the amount of profits made by the business. So Amazon, Apple, yes, your shares go up in price, but they also often pay out every year. They pay out a certain percentage of the surplus to their shareholders. So you might actually get a couple hundred, a couple thousand, depending on how much money you have invested in them. Capital gains, the increase in value of an asset realized when the asset is sold. For example, if you purchase something for 500 and later sell it for 900, the capital gain is 400 bucks. So sometimes that's gold. Like if you buy and sell gold, right? It doesn't go up fixed. Like most of the items on the stock market do not go up fixed, right? Not a certain percentage every year. It might go up sharp, down a little bit, and so forth. So keep that in mind. Appreciation, depreciation. This is important. The change in value of an asset over time. Appreciation is increase. Depreciation is decrease. I hope you understand that. Okay, so appreciation go arrow up, depreciation go arrow down. Okay. You must be able to use this formula. Does this look familiar to you? It's an exponential formula. We'll use that quite a bit. Where V is the future value, P is the present object, R is the rate of change, either positive, in this case, appreciation, or negative in depreciation, T over years. Okay. I will leave it at that for now. Hopefully we can finish this stuff and then tomorrow we'll do the math. So no homework unless I need to make a video. I need to finish this video, okay? Registered plans can be purchased from a bank. Okay, registered plans can be purchased from a bank, which is a lower risk but also a lower return, from a broker or online, higher risk. Some plans can be purchased as mutual funds or simply by they act similar to a savings account. RRSP, Registered Retirement Savings Plan, right? A savings investment designation created by the government of Canada to encourage savings for retirement. When a person makes a deposit, they receive credit against their income taxes. So you get a credit against your income taxes, right? Investments, earnings held inside the RSP are not taxed. So earnings are not taxed as income, but when the money is withdrawn, it is taxed. Money withdrawn is taxed. Okay? That's important. RSPs act as temporary tax shelters. There it is, temporary tax shelters. An RSP essentially combines tax savings and interest earned from the investments made with the funds. Uh, what will I say here? You ready for this? Because you will deal with RSPs. So let's say you're doing good, right? So 1 year you make $80,000. You get taxed about 25 to 30%. So let's say I'm just making a very simple example. So let's go 25% of this. What would 25% of 80,000 be? A quarter. That'd be $20,000 in taxes that you'll be paying, right? That's a lot of money. Let's say we consider the same income, 80,000, but you put $10,000 go into an RRSP. It's as if you only made 70,000. That's what the government does. Like, hey, it's like, oh, you put money into RSP, so that really instead of 80, you actually only made 70,000 this year. What is 25% of that? I need my calculator for that to get the exact number. 17,500 in taxes. So how much money did you save? Like how much less taxes will you be paying? 2,500 in savings, right? $2,500 savings. Tax savings, I should say. Tax savings. And you're like, what happens to the 10 grand, Mr. Dirksen? You leave it in there. It is like a savings account, but it gives you, the interest rate depends on how much risk you put on it. But that money is still yours. It gains taxes. It gains interest. Just put it there. Every year you put some money in there. And then when you retire and make less money, that's when you start taking out from that RSP, but then you will get taxed on that money. So it's a temporary tax shelter. You're already sheltering yourselves from the bell, right? You know what? I got quite far. I'm happy with this. I just want to do one more. This graph I'm going to come back to from time to time. So make sure this is page 8, I think. Put an 8 on top there so we can refer back to this one. Before you pack, this is the interest rate or the return compared to the risk level. Just a little, so if you do low risk, you are usually going to get a low return, right? If you go higher on the risk, which would be stock market, there's a potential for higher return. Okay, I should say potential because you could also lose a lot, but this is kind of like the risk return comparison. So cash, GICs, tax-free savings account, government bonds, real estate, mutual funds, stock and shares. That would be considered the riskiest investment for us, would be stocks, shares, or anything in the market. Why is there a star? Isn't there a star by mutual funds? If the question says low, it's a low risk mutual fund, this actually would come down to this level. If it's a high risk mutual fund, it goes higher up. But in general, people invest into mutual funds and they go a little bit higher risk to make more money, right? And so I will get you to come back to this quite often. So tomorrow we'll start doing math. I promise. No more yapping, not as much at least. And so thank you guys for your time.